Everybody agrees. I mean, even you go on the Federal Reserve's website and you look for the attributes of what is money? What does money have to be? And the very first thing is a store of value. And after that, they go medium of exchange, unit of account, and all these other things, fungible, indivisible, and all that other stuff. And so I came up with a couple of questions that you can ask somebody. If somebody is insisting, no, you're wrong, the euro is money. No, you're wrong, the dollar is money. Ask them, does money have to be a store of value? Is that one of its attributes? And if they say yes, ask them, is there inflation? And if they say yes, then ask them, aren't those two things mutually exclusive?
According to Mike Maloney, the way national fiat currencies operate is like a financial magic trick. All fiat currencies on this planet are essentially borrowed into existence and owed back with interest. But here's the kicker. The money needed to pay the interest doesn't even exist, yet it wasn't borrowed into existence. And when it is finally borrowed, you owe interest on that too. Imagine starting with $1 and owing that plus another dollar in interest. To pay that interest, you borrow another dollar, creating $2 in existence. However, one of those dollars is disappearing into debt payment. Now, you're stuck with $4 worth of debt and $2 in interest, with $1 vanishing to pay off the principal on the first loan. It's like a never-ending cycle where debt keeps piling up. Whenever you borrow money, whether from a bank or the central bank, it shows up as a double-entry bookkeeping item, a debt and a credit. When you make payments, you are essentially extinguishing the debt owed on that balance sheet with the money you saved. But while the principal may vanish, the interest is still hanging around, demanding payment. Maloney's explanation unveils the illusion of the monetary system, revealing how it's designed to keep everyone in perpetual debt. Understanding this system is crucial as we face massive economic changes in the coming years.
And so in our society, there are constantly more loans being made than there are paid. And so if you're talking about M2 currency supply, you're talking about 90% bank credit. And so you go out and find a house that you want to buy. You need $1 million loan. The bank says, okay, here's the loan document you have to agree to. They just check you out and see if they think you can repay it. And if they think so, then here's the loan document. Your signature hits that paper. They imagine $1 million into existence. We're going to loan you $1 million on that house. They imagine that into existence, type it into your checking account. And at the same time, there is a debt owed to the bank on that loan. And so this brand new imagined currency just appears. And when you make the payments on the principal, it vanishes. However, you then have to save up some of the existing pool of currency that is always being borrowed into existence and pay the interest, which is the bank's profit and pays all of the employees and pays for the building and everything else. And it goes out and it circulates. But the point is, those dollars that you're paying with, they were borrowed into existence. They're somebody else's principal that was borrowed into existence just in the currency pool. The more you dig into the monetary system, the more you figured out that this is just such an illusion. It is just, it's amazing. And it's really important right now for everybody to start learning this stuff because we're about to go through some enormous changes in just the next few years. This decade is going to see some upheavals in the monetary system. I do believe that gold and silver are going to be the big winners in all of this. There's two forms of base currency. The first is the paper notes that are in your wallet, and that is an IOU from the Federal Reserve if you live in the United States, the ECB if you're in Europe, Bank of England if you're in England. So the paper notes are one form of base currency, and they used to be the vast majority of base currency. But then with quantitative easing, Ben Bernanke, because of the mechanics of the way quantitative easing works, base currency sort of gets trapped in this second form of the base currency, which is bank reserves. Bank reserves are a dollar that the public never sees, touches, or interacts with. It is something that is only used for interbank settlement and interbank loans. So they're borrowing and lending to one another. And then if I pay you and I write a check to you and you go and cash that check, your bank is going to contact my bank and tell them that you've got a check from me, and they'll make $1,000 worth of the imagined bank credit currency digits, these dollars that are just digits, which the Bank of England actually states these digits are reminders that the bank owes you an IOU. They aren't even an IOU.
Mike Maloney points out a shocking reality about our financial system. The bank owes you paper note IOUs, known as base currency IOUs. There are around $2 trillion of these base currency IOUs in circulation, used by banks for interbank settlements. But here's the twist. The vast majority of the money supply, about 90% of M2, is actually bank credit currency. Those digits in your bank account, they're just reminders that the bank owes you central bank IOUs. Today's fiat currency system is like trading nothing for something, which Maloney calls outright fraud. Banks are inventing digits to remind themselves to pay IOUs, diluting the IOU supply, and stealing purchasing power from all existing currency units. This was evident in the stock market during key and inflation periods. If the Consumer Price Index (CPI) included the stock market, real estate, and other assets, it would more accurately reflect inflation and the money supply's growth. Every dollar created has to go somewhere, and understanding the difference between currency and money can reveal how the system robs the many to benefit the few. During key, money is funneled directly into the stock markets through primary dealers. The correlation between key and stock market increases is astounding. When the base currency rises by 10%. The stock market follows suit, diluting the money supply and directing new money into one sector warps that area but robs others. This is why grocery and gasoline prices stayed low for so many years. The mechanics of creating inflation were primarily inflating the stock market. Maloney's insights expose how the system is rigged, emphasizing the urgent need to understand these financial intricacies as we brace for significant